When it comes to building wealth as a retail investor, setting up an automated monthly transfer is the most reliable strategy available. You set the amount, walk away, and let compounding do the heavy lifting. SIP adoption in India grew tenfold from 3,334 crore in 2016 to 28,464 crore in 2025. Yet most just select the default regular monthly SIP. They miss 6 other structures: Step Up, Flex, Trigger, Multi, Perpetual, and Insurance. Picking the wrong format here isn't going to ruin your finances, but it will lead to one of two outcomes. You will either leave a massive amount of compounding potential on the table, or you will be forced to cancel your investment entirely the moment you hit a cash crunch. The right choice has nothing to do with chasing the highest hypothetical market return. It is entirely about matching the mechanical structure of the SIP to the exact way your specific paycheck arrives in your bank account. We can break these structures down into 3 categories. The first group is designed purely for predictable wealth accumulation, specifically for people who earn a steady salary. The regular SIP is the baseline. You commit a fixed monthly deduction that never changes. If you set it to 5,000 rupees a month, it pulls exactly 5,000 rupees every time. It offers perfect budgetary predictability. But there is a mathematical leak in this strategy. Because inflation naturally devalues money over a 10-year period, investing a flat 5,000 rupees a month means you are actually depositing less real purchasing power into your portfolio with every passing year. This chart illustrates the direct mathematical solution to that inflation trap, the Step Up or Top Up SIP. Look at the baseline on the left. If you invest a flat 5,000 rupees a month at an estimated 12% return, you will have roughly 11.6 lakhs after 10 years. Now compare that to the right. If you apply a 10% annual increase to that exact same starting amount, adding just 500 rupees to your monthly contribution in year 2, and so on, your final balance jumps to nearly 16 lakhs. You capture an extra 4 lakhs. But the trade-off is rigid. A step-up SIP demands predictable annual wage growth. If your salary stays stagnant, those automated 10% increases will quickly start eating into your essential living expenses. Then there is the perpetual SIP. It operates exactly like the regular option, but it intentionally removes the 10-year end date to ensure your compounding is never interrupted by a technical expiration. The risk here is purely behavioral. You have to actively remember to contact the fund house and halt the deductions manually when you finally hit your target retirement number. These wealth builder structures do exactly what they promise for salaried employees, provided you actively manage your salary increases and keep track of your timeline. But if you are a freelancer or a business owner, your income doesn't look like a steady staircase. It fluctuates. Your biggest risk isn't inflation. It's a dry month where a rigid automated withdrawal drains your operating cash. The flexible, or Flex SIP, is built specifically for this volatility. Instead of locking you in, it allows you to notify the asset management company before your due date to adjust the amount. You can scale it up when you land a major client and shrink it down to the minimum during a slow quarter. It keeps you in the market, but by removing the strict enforcement of automation, it requires discipline. It becomes very easy to justify reducing your investment contribution just to fund discretionary spending. You can also use daily and weekly SIPs as an alternative way to smooth out your cash flow and market exposure. Rather than pulling one large chunk out of your account on the first of the month, a daily SIP breaks that allocation down into tiny micro-investments that execute every single business day. While this technically buys into the market at more price points, the mathematical advantage over a standard monthly SIP is incredibly marginal, and practically, logging a separate transaction every 24 hours will severely clutter your bank statements. Ultimately, these cash flow protectors aren't about maximizing yield. They are designed to prevent the absolute worst-case scenario, you fully canceling your investment plan because you had one bad income month. The final group targets active investors who want to squeeze extra efficiency or utility out of the market. The Trigger SIP attempts to automate buying the dip. This graph illustrates how the trigger functions. You define a specific rule, for example, instructing the system to only execute a buy order when the Nifty index drops by 3. You lock your entire diversified portfolio into a single fund house's ecosystem, instead of picking the absolute best funds across the broader market. For the average retail investor, trying to optimize with these niche structures introduces fees, friction, and idle cash that actively defeat the core purpose of passive compounding. So, with all these variations, finding your ideal structure comes down to answering two straightforward questions about your cash flow. This decision tree maps it out. Question 1. Is your income highly variable from month to month? If yes, you need the Flex SIP to protect your downside. If your income is steady, you move to question 2. Do you receive predictable yearly salary raises? If yes, take the Step Up SIP to mathematically outpace inflation. If you have a fixed salary but no guaranteed raises, you stick to the baseline regular SIP to ensure your contributions never exceed your living expenses. Notice what isn't on this map. You should bypass the trigger and multi-SIPs entirely unless you are an advanced market analyst with deep index knowledge. And as a golden rule, keep your investments and your protection strictly separate. If you need life cover, buy a dedicated term life policy and invest the rest. Do not choose an investment plan based on hypothetical maximum returns. Choose the specific structure that aligns with your paycheck, because that is the only way to guarantee you stay invested for the next decade.